Welcome back to Over the Horizon, a Bitcoin podcast. Today I'm here with my good friend and director of Bitcoin strategy, Joe Burnett at Semler Scientific. Today they announced their latest Bitcoin acquisition, and he's here today to talk all about that and more. Joe, how's it going?
Hey, Joe. Thanks for inviting me on. Glad to be here.
Absolutely. I think you and I was looking at our DMs, and the last time you and I spoke was 2022. You were at Blockware. I was at the Bitcoin layer. Lots has changed since then. So plenty to dive into, plenty to talk about. Obviously, your massive new position. I want to start out there. Today's Bitcoin acquisition put you guys over 5,000 BTC on bitcointreasuries.net. You are officially number 15 on the list. You're climbing that ladder, as it were. So talk about the significance of this acquisition. Tell the viewers anything they might want to know about it.
Yeah, absolutely. I mean, you pointed out the key highlights, right? We passed 5,000 Bitcoin on our balance sheet, which is a pretty cool accomplishment. And we're continuing to stack. Like, I think our BTC yield for this year alone is 31.3% currently. And with this latest acquisition, we funded it pretty much entirely from common stock, issuing shares and buying Bitcoin. And it is accretive. You know, it generated a positive BTC yield. And so, yeah, like that's been the game plan for a while. We've got a lot of other strategies in the hopper, some that I can talk about, some that I can't talk about publicly quite yet. But it's a very exciting time. I think a lot of these Bitcoin treasury companies are just eating up Bitcoin. You know, like before I started at Semler, from the outside, you would see these announcements and you'd be like, oh, Strategy bought 6,000 Bitcoin. And you're like, that's cool. Like, but you don't really grasp how large it is until like you're on the inside of one of the larger Bitcoin treasury companies and you actually are buying millions and millions of dollars worth of Bitcoin. It's just kind of an interesting experience. And it kind of also puts into perspective like how large Strategy is. When we put out a pretty big announcement, bought $21 million worth of Bitcoin, and seeing that being executed behind the scenes, and then seeing Strategy say, "Oh yeah, we bought 6,000 Bitcoins for however many millions or millions, hundreds of millions of dollars." So like, it's pretty cool. And yeah, we're going to keep the train going, and we're going to keep accumulating as much Bitcoin as we possibly can.
Absolutely. I love to hear that there are other strategies that you guys are cooking up behind the scenes, because ultimately, everyone is different in the way that they accumulate Bitcoin. Strategy is kind of moving into different preferred stock offerings. They've had their convertible debt for some time. Initially, it was pure common stock issuance to use the proceeds to buy Bitcoin. And so I think, the more differentiated that these companies are in the way that they're, doing Bitcoin accretion, diluted Bitcoin accretion, the better. I think one of the things that you tweeted that I want to talk about is that, essentially all of these instruments, Bitcoin treasury companies are using all of these different instruments, and all of them are a form of intelligent leverage. When I spoke about the company you see behind me, like the very first tweet I did about it, went pretty viral, like 3 million impressions. In the down below it, in the reply tweet, I used the word intelligent leverage, and a lot of people were asking me, what on earth does intelligent leverage mean? And my definition of it is, leverage that is low or no liquidation risk, right? Especially Bitcoin-related price liquidation risk. But it also means using a variety of instruments to serve different cohorts of investors. And this also plays into the second half of your tweet, which was once the monetary premium is dry, the monetary premium being in these different traditional asset classes, bonds, equities, money, right? Which Strategy is tapping all three. Then Bitcoin treasury companies will have the reserves to redeploy capital into profitable businesses at attractive valuations. So I want to ask you about intelligent leverage. I want to ask you about the utility of these different vehicles. And I want to ask you about monetary premium. Huge question, but I'll leave it to you because we're in a world of $1 quadrillion worth of global asset value, and only $2 trillion of it is in Bitcoin.
Yeah, absolutely. I'll start with intelligent leverage because it's a term that Saylor, I guess, originated. It's very generic, and traditional finance types might just like laugh at it. Normal people might be like, I have no idea what that really means, and a lot of people are probably in the middle of that. I agree with you. One way to frame it, or one aspect of this quote unquote idea of intelligent leverage, in regards to Bitcoin is the idea of no short-term liquidation risk. I've said this before, but like over time or over the past, like obviously I understood the Bitcoin thesis and I was like, I need to buy as much Bitcoin as I possibly can. And to do that, you got to deploy all your capital. But then once you've deployed all your capital, you're like, okay, now how do I get even more Bitcoin? And that's where, the temptation to pull out leverage and buy more Bitcoin becomes, apparent. However, it's like before Bitcoin Treasury companies, how would you actually go about doing that? Well, you could go on something like BitMEX or one of these Bitcoin futures exchanges, and you can go 2x long Bitcoin or 1.5x long Bitcoin. But there are some pretty clear, obvious drawbacks to that. One, like you pointed out, is the short-term liquidation risk, where it's like, okay, if I go, I'll exaggerate, 10x long Bitcoin on BitMEX and Bitcoin falls 10%, well, all of a sudden my position is insolvent and I'm liquidated and I lost all of my Bitcoin. And Bitcoin is an extremely volatile asset, as everyone already knows. And so in the short term, it can fall, and it can fall really fast and really significant. We saw that with March 2020, where like Bitcoin fell 50% in pretty much 24 hours. And if you were 2x long Bitcoin on one of those exchanges, your entire position got liquidated and you were a forced seller at the worst possible time. So with a hyper volatile asset like Bitcoin, you don't want to be a forced seller at a very low price and then all of a sudden have the market just chase the price down there, get you to sell right there, and then someone gets a great entry point into Bitcoin. You don't want to be in a position to ever force sell your Bitcoin. That's one. The other two aspects of this idea of intelligent leverage that I think are really important that Semler really hammers out is the idea of long duration but also low interest rate debt. So he kind of started with the convertible notes, right, where he effectively is borrowing money at close to 0% interest. The duration of the debt is 5 years, 6 years, maybe even a little bit more in some cases. And so we know with Bitcoin, it's like, okay, it's very volatile over a 12-month period. It's kind of hard to know what Bitcoin's going to do. Over a 4 to 5 year period, you can be pretty confident that it's going to increase in value probably fairly significantly, especially compared to a bunch of other asset classes. And so this idea of having long duration debt with a relatively low interest rate, or as low as you can possibly get, and then pairing that with Bitcoin, which is a long duration asset, right? Like we don't know what it's going to be worth in the short term, but we're fairly confident that over a long period of time, it's going to be worth significantly more. That's kind of like a match made in heaven for Bitcoin. But again, like you couldn't do this before Bitcoin Treasury companies, really. Like Bitcoin Treasury companies, publicly traded companies, have access to the convertible debt market. They have access to the preferred equity market. And so they can structure these fixed income instruments, tap into leverage that normal people couldn't access, even like hedge funds couldn't really access. And it creates a pretty compelling product where, in a way, you're effectively like 1.2x long Bitcoin as long as they maintain that leverage ratio. And that enables you to potentially amplify the future returns of Bitcoin, which is fairly attractive for someone that is interested in Bitcoin and thinks Bitcoin's going to go up over the long term. So I think that's the idea of intelligent leverage. On top of that, your second part of your question, this idea of, what are Bitcoin treasury companies going to do once they have hundreds of thousands of Bitcoin? Like it's a good question. Like right now, and I would say for like the short to medium term, which could be 5 to 10 years potentially, the play is probably to do exactly what strategy is doing, where buy as much Bitcoin as you possibly can. You maintain an intelligent leverage position. You maybe have an operating business that can stack more Bitcoin over time as well. But at the end of the day, it's like issue fixed income liabilities, buy more Bitcoin, amplify the future returns of Bitcoin. But long term, when these companies hold lots and lots of Bitcoin, what happens? I think my general thesis with Bitcoin, and you mentioned the 1 quadrillion or $1,000 trillion worth of global wealth around the world, is a pretty simple thesis. It's the idea that money is broken, therefore people are chasing yield by investing in real estate, equities, fixed income, you name it. Uh, they're forced to chase this yield because the money is broken. And so what does that do? Well, it bids these assets up higher than they should be bid because they know they can't hold the actual dollars themselves. And so what this does is it creates this natural monetary premium in each of those asset classes. And if Bitcoin is good money and we're moving towards Bitcoin and Bitcoin is growing in value, eventually I think Bitcoin will take the monetary premium out of those other asset classes and into Bitcoin. And maybe at that point, Bitcoin's like a $300 trillion asset or maybe more. And at that point, once the monetary premium has been sucked out of other businesses, then the valuations of those businesses might be a lot more attractive. And in that sense, on a risk adjusted basis, it might make sense to deploy some of your capital into an actual business that could outperform Bitcoin itself over the long run. But like right now, it doesn't make much sense because the whole Bitcoin thesis is there's a monetary premium in everything else except for Bitcoin. And therefore, Bitcoin is in the hyper Bitcoinization process of sucking that premium out of those overvalued assets and into Bitcoin. So that was a long answer, but I think that's how I'm thinking about it very broadly at this point.
Phenomenal. And we'll dive more into it. You probably saw the smile on my face because I just wholeheartedly agree with you. And I wrote this big piece on it. I think I told you about it.
Yeah.
Hopefully it'll be live at some point soon, probably by the time this goes live. Essentially, post 1975, I took that year because it's soon enough after the gold standard, but it's also long enough post World War II that the industrialization boom kicked off. So for the first 3 decades or so, 25, 26 years of post-World War II, this globalization, industrialization boom took place. And that was all on a hard money standard, right? And then 1971, all of that went away, right? We left the hard money standard. And so all of that monetary capital that was in the dollar began looking for a home elsewhere. All of this investment capital. And so whereas the stock market used to be a way for you to invest in the operations of your favorite company, now more than anything, it's just a way for you to pray at some point you can retire, right? And this is the reason that single stock investing has fallen to the new king, which is passive flow investing, and they invest in the index, right? They don't care what company it is. They just care that they're invested in the best performers, right? So it's completely morphed the reason the stock market exists. Same thing with the bond market, right? Ultimately, it's become a game of chasing yield. And when real monetary debasement is, 6 or 7% annually compared to what the CPI says, and the yields you can find in the fixed income market right now in the U.S. Treasury market are 3.5%, 4%, 4.5% maybe. It forces people out on the risk curve. And so instead of just fulfilling a mandate to hold fixed income, you need to go out riskier and riskier and riskier. And so it's distorted the bond market. Other places you have $18 trillion in art, something like $30 trillion in art and cars and collectibles, maybe a little less, and $330 trillion in the real estate market. The calculation I did on the real estate market was I did 2 separate methodologies for this. I won't get into it, but it's about 35% of the value in the $330 trillion real estate market is just pure air, pure monetary capital that was looking to find a home. And Bitcoin treasury companies are speculatively attacking the dollar and siphoning the monetary premium out of those assets, right? Short USD, long Bitcoin. That was another tweet that you put out. I want you to explain the speculative attack, exactly what that means and why companies, particularly in the United States, but elsewhere, like in cases like MetaPlanet, are uniquely positioned to execute that trade. You already touched on it because of their access to capital markets, but why don't you, for the viewers, explain what speculative attack means and exactly how these companies are doing it, how Semler is doing it as well.
Yeah, absolutely. So yeah, the entire idea of a speculative attack is borrowing the weaker currency to buy the stronger currency. And so in the example that the Bitcoin treasury companies are doing, most of them are borrowing dollars and buying Bitcoin. And this whole concept, I think, actually becomes very clear and easy to understand with the new preferred equity that strategy just issued called STRC. And effectively what that preferred equity is is they try to peg it to a dollar, or they're going to try to peg it to a dollar. And so in the sense, it's like a money market fund or a high yield savings account. If you have money inside STRC, it's exactly like a high yield savings account or a money market fund. And so what is this entire idea? Well, Strategy issues STRC. They create new shares of that. Someone buys it, and then they use the proceeds to buy more Bitcoin. And so MicroStrategy is borrowing dollars, and in fact, they're kind of creating it out of nothing. Like someone else puts their dollars in, and then they created the STRC kind of out of thin air, and then they use that money, that the cash that they raised by issuing STRC, to buy more Bitcoin. And so it's this basically the entire idea of a speculative attack, where you borrow money in a way that kind of creates a new dollar denominated asset out there. And then that money is used to acquire more Bitcoin. Semler Scientific basically did a very similar thing earlier this year, where they issued a convertible note for $100 billion or $100 million. Hopefully we'll get to $100 billion in short order, $100 million, and then use the proceeds to buy more Bitcoin. And I think that that's kind of, exactly what makes these Bitcoin treasury companies super interesting. They borrow money and borrow dollars and buy Bitcoin. And it's like everyone, if you're in the Bitcoin community, the Bitcoin trade, right? Like the Bitcoin trade, it's not really a trade, but you buy Bitcoin and you hold it for decades, and you expect it to become reach gold parity, or eventually hit a $100 trillion market cap or even higher. And that's a great trade. But at the same time, if you expect that, you also should really be expecting that Bitcoin will outperform everything else, right? It's probably going to outperform equities, probably going to outperform real estate. It's also definitely probably going to outperform fixed income. And so the Bitcoin treasury trade, where I did that tweet that's basically saying buy Bitcoin, short USD, the Bitcoin treasury companies are just doing one extra step in the obvious trade that everyone sees, where it's like, okay, not only do we just want to buy Bitcoin, but we also want to short the dollar. And we do short the dollar via intelligent leverage by effectively issuing kind of these dollar IOUs out into the market. That's what debt is. And then using the money that we raise to buy more Bitcoin. And obviously that amplifies the future returns of Bitcoin. That's just what leverage does. That can be good or bad, right? Like if Bitcoin is actually going to $100 trillion and outperforms fixed income, then it's reasonable for that position to amplify Bitcoin's returns, and Bitcoin's returns would be really good. It can also be bad in the sense that if over the next 12, 24 months, Bitcoin goes down, well, you amplified your future returns further down than they otherwise would have. Now, you have to be willing to expect, over time, you would only do this trade if you expect Bitcoin to do very well and you expect it to outperform fixed income. But I think many people within the Bitcoin community do expect that. And so that's kind of what I tried to articulate in a very simple and clear manner. Bitcoin treasury companies are just buying Bitcoin and shorting the dollar.
Fantastic. You mentioned it amplifies Bitcoin's returns. Ultimately, I think it was also you that tweeted out the Stanley Druckenmiller quote, not to diversify, but, I put all of my eggs in one basket and then watch that basket very closely. Of course, there are risks associated with a Bitcoin treasury company, applying all this leverage to stack Bitcoin. But that's the utility of this entire thing, right? That's the utility of intelligent leverage, and that's what these companies are willing to bet on, right?
Yep.
Because so far over Bitcoin's 16-year life, it's been a pretty surefire bet. I wanna switch gears here, and then we'll go back into Bitcoin treasury companies. You have a fascinating story. It lines up somewhat with my own. You tweeted out, "It's mind-bending how much X has changed my life over the last 7 years." So I wanna have you explain what you mean by that and kind of how you got your start in this entire industry.
Yeah, it's a good question. I thought about that last night. I've thought about it over the years, but I really started to think about it a lot last night. I mean, I started using Twitter like most people. I mean, I was in high school, I guess, when I first started using Twitter, which was a long time ago. But in college was when I started to get kind of involved with Bitcoin Twitter. And I think at the time, like I made a pseudonymous account pseudonymous account, where it was just a cartoon character. I think I was a bull on the moon for an extended period of time, for probably multiple years, and I just remember it was 2017, and then 2018 bear market set in, and I was so convinced that Bitcoin was right. I was trying to read everything that I possibly could as to why I could be wrong, just to try to I was like, this makes so much sense. It's fairly obvious once you take the time to really think about it. And the arguments that I was reading that were saying, oh, it's a bubble or a Ponzi scheme or whatever else at the time, they were just unconvincing arguments to me. It just felt like it was written by or articulated by someone that didn't take the time to think about Bitcoin or really question what money is to begin with. And so all of 2018 and 2019, I was drafting Twitter threads, not necessarily because I was trying to explain the world what Bitcoin was, but it was more so trying to simplify my Bitcoin thesis and then see if people would say, oh, you're wrong because XYZ. And people would do stuff like that, in 2018, 2019. And it kind of, throughout that bear market, as Bitcoin fell from $20,000 to $3,000, it kind of solidified my understanding. Okay, yes, price is going down, but the counter arguments against Bitcoin, I still think are relatively wrong. And it only kind of made me more confident that maybe I'm right about Bitcoin, and maybe this thing's going to go a lot higher from $3,000 Bitcoin. And so I started really with Twitter threads, and then 2020 rolled around. I think in 2020 I was still a bull on the moon cartoon character on Twitter, and Michael Saylor even followed me while I was still a cartoon character effectively. And after that, I eventually changed my account to actually being my real name. But I kept writing Twitter threads over time. Eventually, maybe a year and a half ago or 2 years ago, I started to make the shorter, concise Bitcoin explainer videos, very similar to yours, which are also really great and good for Bitcoin. And it's just funny how over the years, my first real job out of college was doing technology consulting at EY, and I thought that would be something that I might end up doing for decades. And little did I know, Twitter was going to lead to a job working in Bitcoin full time, and led to eventually working at Unchained as well, and then now has helped me get a job at Semler Scientific, one of the largest Bitcoin treasuries in the world. And I think a lot of it is literally just because of being on Twitter, thinking about Bitcoin, articulating my Bitcoin thesis, whether that's via drafting threads or writing about it, or whether it's recording a video and speaking about it. And it's just crazy to think about the journey and how powerful the platform has become.
It's awesome to talk to you about this, because when I was doing something similar, it felt like I was the only one. It felt like I was insane. And now looking back, there are a handful of us that have done something like this. I can count basically five, counting you and me as well, who have done something like this and essentially just posted their way into a position, in this kind of growth trajectory. And so for people who might be listening, for younger folks who might be in school or people fresh out of school, if you could go back in time, picture yourself giving a piece of advice or a few words of wisdom to yourself 4 or 5 years ago, back when you were still making this plunge, what kind of advice would you give to people today that are in that position now that you're here?
Yeah, it's a great question. One point that I like to make, when people say, can I get a job in Bitcoin, or, something along those lines? One, I don't think everyone needs to work in Bitcoin per se. I think it's it's really great. I love it. But I also think that there's nothing wrong with working a normal technology job or construction job or whatever job. And if that's the best way that you can maximize your cash flow as an individual in the short term, medium term, or perhaps even the long term, then that's how you're going to stack more Bitcoin, and that's potentially going to be better for your family. So one, I don't think everyone needs to work in Bitcoin, because it is, everyone wants to. It's pretty hyper competitive, and it's you can make decent money, but it's also, if you do technology consulting or investment banking, like you can probably make a lot more money outside of Bitcoin, too, which might enable you to stack more Bitcoin. So one, it's great, but two, not everyone needs to do it. If you want to do it or you want to be involved with the community in whatever way, my best advice, I think, over the years has been to create content or create a product, whether that's like a software product or whatever else. That's, like I said, like I started writing Twitter threads and then eventually I started creating videos and then eventually I started hosting a podcast and then going out on podcasts. And I think if you can, and I've created like various like Bitcoin software products as well. Nothing too crazy, but that was something I did a while back as 2020. And so like just creating things for the Bitcoin community is exactly how people start paying attention to you, people start learning about you, people start to click follow, and then you start to build a network. And so I think that those are kind of like the key things that I would do, just build things, and people might start paying attention if you can build something cool.
Fantastic. Wise words, and I share the exact same advice. Not everyone has to work into Bitcoin. In Bitcoin, ultimately, provide value in whatever way you can, whether that's in the Bitcoin industry or whether that's elsewhere, and be loud about it. Right? Be loud about the value you're providing. Be distinct. Do something that people aren't already doing, or do something that people are doing already but better. And then eventually you'll find your place. Right? Whether that's in Bitcoin or elsewhere, just provide value to the best of your ability. And then use those proceeds reasonably to stack sats.
Exactly.
That's fantastic. Let's shift gears back into talking about Semler. I want to ask you about MNAV. You had a tweet about MNAV specifically that said, even if Bitcoin Treasury companies get crowded, the industry gets crowded, and all companies trade back to 1x MNAV, using intelligent leverage will still outperform Bitcoin itself, assuming Bitcoin outperforms fixed income over the long run. So we look at the current fixed income market. You can get, a 4.5% rate in a money market fund. That's about a $7 trillion market. You can get anywhere from a 0% rate to a 4.2% rate in a bank account. That's about an $18 trillion market. One of the main objections I've found, I made a video about this a few days ago about what Stretch will do and how it can potentially consume this market little by little by little. One of the main objections that I found is that, well, this is risk-averse capital. This is risk-averse capital. There's no chance that they're ever going to touch something like Stretch because of it being Bitcoin adjacent. And then we get the news today that Stretch was the best IPO offering from Strategy in its history. Oversubscribed, they double the size of it, and so clearly there's demand for this thing. So we'll ask about trading at 1x MNAV, but first, what do you think about that argument that this capital that Strategy and other places are trying to target by issuing preferred stock, it's capital that's too conservative? I know what I would say to that, but what would you say to that?
Yeah, it's a good question. And I mean, you think about the preferred equity that Strategy has issued so far, it's still it's like tiny compared to, the entire fixed income market and the entire money market funds and bank accounts and high yield savings accounts and T-bills and whatever else. So it's very small currently. I agree that a lot of that money, hundreds of trillions of dollars effectively combined all together, is very likely risk averse and scared. However, it's like if the preferred market for Strategy is now it is going from 3 billion to 7 billion or 3 billion to 5 billion or whatever it will be, it's like it is still so small compared to that entire market that you don't really need much of that very conservative capital to want to flow into some of these instruments that arguably are better. It's like, yes, maybe it's obviously STRC is not a FDIC insured bank account. However, it's probably, it might be safer than, a junk bond or some other crazy fixed income instrument. And arguably, like a Sailor would say, it's like it is safer. And like he's created models on his website where it kind of shows like, okay, like you can put in your assumptions for Bitcoin. If Bitcoin remains X volatile and grows 0% over, the next 10 years or till the duration of these preferred, till the duration ends or over the next 10 years or whatever it might be, then you can like statistically model that out and show that, okay, it's actually still mispriced. Like maybe there's some risk to it, but the risk is relatively small compared to how much yield you're making, and you theoretically would be making a positive risk adjusted return. And now if you take it a step further and you're like, okay, I expect Bitcoin to go up over time, right? Which isn't, even if you're a skeptic, I don't think that's that much of a stretch to say that Bitcoin will go up over time. Like I did a tweet the other day basically saying, it's surprising that people think Bitcoin is going to go up over time when the price of like ramen noodles is designed to go up over time. Like basic consumer goods that are incredibly abundant, those prices go up over time. This is like the most scarce monetary asset in the world that is in the process of being adopted. It's almost like crazy to think that it wouldn't go up priced in dollars over time. It's pretty should in my mind it's fairly obvious and kind of hard to argue against. But yeah, I mean, and so I think like even if you are a skeptic and you do Saylor has those models on his website, it still looks pretty good. If you think that Bitcoin's going to grow over time, then it starts to look even better. And again, I think like the fixed income market is so large, it just makes a lot of sense. And another way that Michael Saylor has explained it, which I think is really good, is like a lot of the corporations or governments or whatever that issue these fixed income instruments borrow dollars and promise to pay it back. A corporation, for example, they don't have money now and they want to borrow it, and they promise to pay you back in the future based on money that they don't have right now, but they're going to make it over time, right? Like that's like logical for borrowing, but that's what it is. Strategy and Bitcoin treasury companies are like the exact opposite. They're like, we have a lot of money right now. We actually have billions of dollars of money. We have the money. We just want to borrow a little bit more to buy more money. And yeah, like it's 5x over collateralized or 10x over collateralized. And so it's like we have the money. We just want to borrow a little bit more and have more money. It's like it's kind of the opposite of every other corporation or government that borrows money. Like they don't have money. They hopefully plan in some elaborate way to get it in the future and then pay you back. Whereas strategy is like, no, we have the money, but we'll borrow a little bit more just to amplify our returns. And so it's like flipping the whole concept kind of upside down. And when you kind of frame it, there's different ways to frame it like that. And like when you frame it like that, it's like, wow, this actually could be the most conservative fixed income instrument that you could possibly have, which then, your brain starts to go into overload.
Yeah. Sorry, your brain starts to break a little bit because if we think of like the risk curve when we think of these fixed income instruments, way at the bottom, I mean, if we just think traditional assets, way at the bottom, physical gold, right? No yield, can't touch it, but it's a good monetary savings good. Next up is U.S. Treasuries. They're the next risk-free thing. But why do we consider them risk-free, right? Because the assumption is that productivity growth in the United States and the taxes that will come from it, or investment from the government of the United States and the proceeds that will come from it, will be used to pay off this debt. But also because they can print the difference if it can, right? That's why it's considered risk-free. And then you move up to relatively low yield, AAA corporate bonds, or lower yielding AAA corporate bonds. The premise immediately becomes they don't have that printing mechanism. So if things go bad, they can't help you. But we don't have this money today. We want to borrow it with the promise of being able to generate it in the future. That's what fixed income is. You are making an investment over time, right? And so not only does strategy flip this on its head by saying, all right, we have billions of dollars, 607,000 Bitcoin on our balance sheet. We're just going to borrow a tiny little bit of cash in order to buy some more Bitcoin, right? Ultimately, you're exactly right. It's extremely over-collateralized. It's extremely safe. The reason people don't think it's safe is twofold in my mind. One, because Bitcoin is still perceived as an extremely risky asset, right? Oh, Bitcoin, that thing that crashed in 2017 or crashed in 2021. And number two, because ultimately, post 2021 and 2022, when you think leverage, you're not thinking intelligent leverage. You're thinking FTX style leverage, right? When you hear leverage, it's become a bad word in Bitcoin as a result of what's happened in crypto, right? And so I think for those two reasons, people fundamentally misunderstand what strategy is doing, what these other entities are doing. You're right. Fixed income is a $318 trillion market. The U.S. Treasury market is like $30 or $35 trillion now. And the reality is, why are these things necessary? You made another video about why 97% of institutional capital now has access to Bitcoin through these vehicles. This is from a strategy slide. I'll show it if I remember to put it up in post. But 97%, you got that number, of institutional capital is mandated to equity and credit. only $3 trillion of it has access to the commodity market, $700 billion in private capital, and $2.3 trillion in central banks, mostly allocated to gold. But when we're talking institutional capital, they cannot get spot Bitcoin exposure, but they crave it. And Strategy currently has the most amount of instruments in the game. And so really, it's ultimately like the winners of the future are the people who create these bridges today, are the people who create the bridges from the equity market and the credit market and even the real estate market into Bitcoin, because ultimately there's monetary capital everywhere. Post 1971, every monetary capital basically spread to the four winds into assets where it didn't belong, and now it's stuck in these assets with no way to get to Bitcoin. The winners of today are building those bridges. Semler Scientific, Strategy, Metaplanet. I'm curious to hear your thoughts on that. I believe, the game over the next 5 years, 10 years, 15 years will just be building the best bridge. That's it, between all of these asset classes to Bitcoin.
Yeah, I think that was very, very well said. There was another really interesting graphic that I saw that I think explained it very well, especially for Bitcoiners that have seen the graphic before. But you have the total global wealth chart where it's like, art, gold, real estate, fixed income, equities, whatever else. And then people show like where these preferred equities kind of sit on each of those asset classes into Bitcoin. And it's like it's explaining what you just said, where it's like STRC is kind of the bridge from dollars. Oh yeah, exactly. Dollars and money market funds. And then you have STRF, STRD, like that's the pulling from the fixed income markets. You have MSTR, SMLR, all the other Bitcoin treasury companies, that's pulling from the equity markets. And then I saw like another one, like Horizon could be pulling from the real estate market.
That's the idea.
Or even like STRK could, to some extent be kind of pulling from the real estate market where like people buy real estate because they want an asset that goes up a little bit. They want it to pay you like rent every month. It's like, okay, well, that's kind of what STRK does. And, I'm sure, other Bitcoin treasury companies are going to release, similar preferred instruments that are effectively just building bridges from these major asset classes that have been exactly like we laid out before this. Like everything's monetized, everything on this chart has a pretty significant monetary premium. And we're just, the money broke so bad, we finally found a good money. Now we're just building the bridges back and sucking that monetary premium back into Bitcoin. And like you pointed out, the strategy slide that highlights how 97% of institutional capital must buy bonds and equities, it makes perfect sense why we kind of got there, right? Like before Bitcoin and really before Bitcoin, commodities were not a good investment. Gold has done like decent over the years, but gold's mostly irrelevant. At this point, it's like the average person, the average wealthy person doesn't really hold much gold, if any, really at all. Most people hold real estate, equities, and fixed income. And so it's like all this institutional capital has to buy equity, has to buy credit because over the last 50 years, that's been the best thing that you could possibly buy. And it's smart. Like, you're on paper, you're investing for the future. Obviously, there's been tailwinds behind both of these because of monetary debasement and perpetually lower interest rates. But I think that it makes, perfect sense that now that there's these mandates by mutual funds, foundations, traditional asset managers, hedge funds, so many other different traditional asset managers, they have to buy these instruments, and Bitcoin treasury companies are going out there and building the bridges from equities and credit. And if it's powered by Bitcoin, and Bitcoin is like Michael Saylor says, is Bitcoin's performing 30% compound annual growth rate every year. Well, both of those, equity and credit, if it's powered by Bitcoin, you can create better risk-adjusted returns for the investors if you just plug Bitcoin into these core fundamental asset classes.
100%. I mean, I think so few people understand these things. One of the main comparisons that I see drawn is that Bitcoin treasury companies are no more than penny stocks who are buying Bitcoin on their balance sheet. They're not doing anything quote unquote important. I believe Bitcoin treasury companies are accelerating this transition that you and I just spoke at length about for the last 5 or 6 minutes, which is that this monetary capital needs a home. These companies are building the bridges for this monetary capital that has mandates to indirectly invest in Bitcoin, right? And in doing so, it raises Bitcoin's market capitalization. More people are encouraged to build those bridges, and it depresses the monetary premium. It deflates away that monetary premium that exists in these other asset classes. And so, really, I want to hear your take on kind of the opposition, the other side of this argument. People calling Bitcoin treasury companies penny stocks, or similar to the ICO bubble, yada yada yada. I feel they're doing something far more important. I think you tend to agree with me, but what's your response to treasury company detractors?
Yeah, it's a great question. One, I think like there can be multiple, negatives to Bitcoin treasury companies. One very obvious one that I agree with is you are giving up control of a physical bearer asset, right? Like treasury companies are only interesting because Bitcoin is a like non-sovereign, perfectly scarce bearer asset that you can hold that no bank or no government can take from you. Like that's why this is interesting to begin with. Treasury companies, are a little bit different, right? Like if you have shares of a treasury company, well, you have that in your brokerage account. Arguably, it's a lot more censorable than physical Bitcoin that you simply hold the private keys to. So that's a negative. Like it doesn't. Treasury companies don't replace Bitcoin. They can help amplify the returns of Bitcoin, and they can help be the bridge, like we were talking about right before, of capital that's trapped in S&P 500 or long-term treasuries or medium-term treasuries or other fixed income instruments. They're bridges to those sources of trapped capital and also the people that want to outperform Bitcoin, right? Like again, the whole thesis is Bitcoin outperforming fixed income over the monetization of Bitcoin. And that's exactly what Bitcoin treasury companies are doing, and they're trying to amplify the returns by borrowing fixed income and then buying more Bitcoin. The other detractor, I guess, of Bitcoin treasury companies, or what people would argue potentially, is like there is like a lot of short-sightedness. I feel like in some of like the Bitcoin treasury community, where it's like people want to make money really fast, and like some of these Bitcoin treasury companies are making money really fast. Like Metaplanet is, which is a great. I love Dylan and Simon. They're incredible and great leaders. And they've built an incredible Bitcoin treasury company, but it's also like it's powered partially by the very high MNAV premium, and like they issue shares at the high premium and buy more Bitcoin, and the stock price soars because of that. Obviously, eventually premiums can go away, and it's like whether that's strategy, similar, Metaplanet, or whatever else, like there's potential downside with and just the premium, compressing relative to actually Bitcoin going down as well. And so, there are negatives to these treasury companies. The other potential negative is like it's volatile, right? People think Bitcoin's volatile. Like these Bitcoin treasury companies, you pair a little bit of leverage on top of Bitcoin. Well, they're designed to be more volatile than Bitcoin itself, which is like very different from normal people. If like we've been in Bitcoin for a while, where it's like an 80% drawdown in Bitcoin doesn't feel great, but we're kind of used to that. If Bitcoin falls 80% from wherever it is, treasury companies will fall more than that because they're again leveraged Bitcoin positions. And so normal people would not be able to take that intense volatility. And you just have to have that in mind that yes, you're going to amplify future returns, and that can be up and down. Obviously, if you're optimistic about Bitcoin, which I definitely am, I think Bitcoin is going to outperform fixed income over the long run, and therefore I think Bitcoin treasury companies are going to do very well over the long term. But that's the other potential detractor against Bitcoin treasury companies. But overall, I think generally, like very broadly, I think Bitcoin is one of the most hated trades and most contrarian trades in all of like investing right now. And it's kind of been that way for the last 16 years. And it's part of the reason why I think Bitcoin has outperformed just about everything. I think Bitcoin treasury companies are like the hated trade within the hated trade, which actually makes me more bullish because I want to do contrarian things and spot ideas that people are discounting, because that's how you like generate alpha and outperformance when you're investing money. And so I think the fact that it's still kind of like hated, like especially outside Bitcoin world, but even inside the Bitcoin world, some people don't like it, which in a way just kind of makes me more optimistic on the whole thing, because I think it's just like, how we are talking about when I first got into Bitcoin, writing the threads and trying to understand Bitcoin and try to articulate my thesis and try to hear the counter arguments. The counter arguments are just not that convincing to
Mhm.
me. And the fact that there's a lot of counter arguments that are of poor quality makes me more bullish because it makes me think that, okay, I have some sort of information asymmetry over the market, and therefore there could be significant, performance for the way I'm allocating capital compared to the market.
Absolutely. I tweeted, and I think it's pinned on my profile that Bitcoin is a $2 trillion. Bitcoin is a $100 trillion idea that's currently valued at $2 trillion. And so ultimately, more people than 5 years ago have caught on to that. That's why they're long Bitcoin, because they're expecting those asymmetric returns. But if you put yourself in the shoes of a Bitcoin treasury strategist today, or a retail investor in Bitcoin, invested in Bitcoin strategy companies today, you are even more contrarian than that, potentially 5 years ago, 6 years ago, than the core Bitcoin idea itself. Ultimately, the reason people are invested in Bitcoin is because they know that something that the market is discounting extremely heavily. They understand, as Lynn Alden puts it, this train has no brakes. And so for them, Bitcoin is the only asset more often than not that they invest in, right? Maybe they hold a few other things, a few other hard monies, because they understand the fiscal reality that is facing this country. And by extension, the fiscal reality that's facing every other country, right? Ultimately, debt issuance has to accelerate at the sovereign level. Ultimately, there can't be an appetite beyond a certain point. There's going to be a diminishing appetite from the private market at a certain point for that treasury capital, for that sovereign debt. And so central banks need to step in, print the difference, a snake eating its own tail over a long enough time frame. That's the Bitcoin idea. Now, the Bitcoin treasury idea is even more contrarian than that. It's that if we take this speculative attack one step further, not just buying spot Bitcoin at the individual level, but also leveraging access to this system, to traditional capital markets where hundreds of trillions of dollars is locked away, and creating vehicles and applying intelligent leverage to perform that exact same speculative attack idea, but at the corporate level. And so similar to you, the arguments that I've seen against Bitcoin treasury companies, for the most part, fall about as flat as the anti-Bitcoin arguments, right? And I believe 5, 10 years from now, the anti-Bitcoin treasury arguments that we hear today will sound just as short-sighted and just as unpolished as, the Beanie Baby argument or the Tulip Mania argument that we hear against Bitcoin today. I fully agree. I saw a tweet, and I'll credit the person who wrote it in the description. I can't pronounce the name correctly. It says, I think it's Shaitan Call. But he said Bitcoin grows at a rate of monetary debasement plus the rate of adoption plus human productivity growth. We talked briefly about how these other asset classes are inflating, partly because capital is trying to find a home, but also the monetary premium is coming from just the denominator getting debased, right? So do you agree with that tweet, right? This idea that Bitcoin grows at a rate of monetary debasement plus rate of adoption plus human productivity growth? And if so, what role do you think Bitcoin treasury companies play in the Bitcoin equation?
Yeah, it's a really interesting tweet. And I think like this whole idea ties into the idea of like what's going to be Bitcoin's CAGR over the long term. Like obviously in the short term, we're all kind of betting that adoption grows, and hence that's why Bitcoin's CAGR has just been like astronomical over the last 10 years or whatever, because there's a scarce amount of Bitcoin and it's growing really fast. But like what happens, kind of like excluding the adoption side of things, it's like it's monetary debasement and technological innovations, which is effectively like saying like technology deflation is going to lower prices, but it's going to lower prices in the best form of money, and the best form of money is Bitcoin. So I would say yes, I do. I think I do agree with that as of right now. I've thought about it obviously a good amount, but I want to think about it more, and I want more people to be like researching this idea because I do think it's extremely interesting. But yeah, I mean, I do think that like if you double the amount of dollars in circulation, arguably Bitcoin like overnight holding everything else equal, then it would be logical that the price of Bitcoin doubles. On top of that, if Tesla comes out tomorrow with self-driving cars and the cost to Uber, whether that's with Tesla or another competitor, is now dropped significantly because there's not a human in the cost equation there, and then Waymo comes out and has their self-driving car. Well, it's like the cost may have dropped 80 to 90% on calling an Uber. But all of these companies that are competing, offering Ubers, are going to be competing, right? Like that's a beauty of capitalism. It's a race to the bottom in terms of margins. You have Jeff Bezos' famous quote, like your margin is my opportunity. And so at the end of the day, like new technology advancements ultimately just lead to, or should be leading to, natural technology deflation, which means that if the cost of something falls 80%, then eventually the price might actually also fall like roughly 80%. And so until the margins are tiny and these companies are just competing, very aggressively with each other. And in a way, that's going to be, sucked into Bitcoin, because, where if the companies got more competitive, and the margins are getting squeezed to zero over time as markets become more competitive, more global, and whatever else, it's like that's just the natural nature of free markets. And so yeah, I agree. Like I think that monetary debasement plus technology deflation plus like Bitcoin adoption are like kind of the three. And I think that's what you said. Maybe there's another one, but in my view, those are like the three drivers of the price of Bitcoin.
Phenomenal. Potential video for you. I'd love to see that video tomorrow or
Nice.
another day. It's kind of interesting because and anyone who's read The Price of Tomorrow knows this. It's like at the same time that we have accelerating technological innovation, right? Joe and I are talking to each other from 500, 600, 700 miles apart, I think, something like that. The latency is basically 0 milliseconds. It's instantaneous. You're watching this on a supercomputer of your own, whether it's on Twitter or whether it's through Spotify or on YouTube. Yet the price of these things has increased over time, despite them getting better and better and better every year. And this thing didn't even exist several years ago, right? Of course, when it was a nascent technology, it was expensive, but over time, it should be becoming less expensive for the same thing. The reason this isn't happening is because on the other side of this tremendous technological acceleration, you have a central bank whose mandate, and this is one of its actual mandates, is to make sure that prices inflate by 2% every single year, right? Because otherwise, in their logic, people would stop buying things, which is insane. I think Joe and I can agree on that, as we agree on many other things. But it's kind of interesting, and Bitcoin really resets all of that. It makes it so that the denominator actually reflects physical reality again, right? And so all of these goods and services, this technological acceleration should lead to technological abundance, should lead to individual prosperity. But we have an institution on the other side of this trade that's denominating everything, that's making sure that technological acceleration is also met on the exact same side with monetary debasement acceleration. And so it's making it so that rather than getting less expensive, rather than life becoming more abundant and more prosperous for all of us that live in this country and other countries around the world, it's the opposite. Things are becoming more out of reach. And Bitcoin really resets that at a global level.
Yeah, I completely agree. One thing that I'll add that I think is interesting is like, how do we even get here to begin with? Like, why is our money designed to debase? Period. In my opinion, it makes perfect sense how we got here. Like, gold was an inferior monetary technology. Banks kind of formed on top of that. It was intuitive and easy and smart, honestly, to hold dollars in a bank account because then you get some yield on your dollars. And then the monetary system itself effectively becomes like a debt-based monetary system where your dollars in the bank aren't actually sitting in the bank. It's a loan to someone else, and so on and so forth. And to keep that debt-based monetary system going, that naturally emerged because of the tools that were available at the time, and the fact that humanity was becoming more global, more connected, so on and so forth. The fact that the debt-based monetary system exists, you have to kind of keep debasing the money and slowly over time to like keep the amount of debt and the amount of credit in the system from contracting. Because if the debt-based monetary system starts contracting, then trade actually does halt, right? Like banks, take it to the extreme, every bank basically fails because they loaned out money to someone that can't pay it back, and then everyone's worried about their actual money that's sitting in their account because the loans that they made were really bad. And then like the actual economy does kind of fall to a halt in a debt-based monetary system. But in a non-debt-based monetary system, I think, something like Bitcoin, prices could actually fall and deflation would actually be good. So like in my view, it's like we got to where we are from like a natural evolution of how it was going to happen to begin with. Now that we're upgrading to sound money, that's a bearer asset that no one really wants to create Bitcoin IOUs, or like no one wants to lend out Bitcoin because it keeps going up in value. We're kind of at a less likely point to ever get into a huge debt-based monetary system built on top of Bitcoin. There will be debt on Bitcoin, but it won't be, you know, in dollars. Like there's very few dollars and there's a whole lot of debt. Whereas in the Bitcoin world, there might be a whole lot of Bitcoin and like a little bit of Bitcoin debt, and then a little bit of equity in businesses and whatnot. And so it's like it kind of like flips everything. And I guess my entire point of saying this was I'm not surprised at where we ended up, but I expect it to change in the future.
Absolutely. I mean, we arrived here out of a need for efficiency. Ultimately, there was a great deal of moral hazard that was going on in the debt-based monetary system, and gold was simply a bad underlying asset. And so gold was simply removed from the equation, and that moral hazard was allowed to proliferate. But out of gold's inefficiency and the fiat distortions that followed, Bitcoin's efficiency stepped in, right? Bitcoin was created as a superior hard monetary asset to be the base of global finance out of everything that occurred when we removed it. And so really, we moved away from this hard money standard out of a need, and we're moving back to this hard money standard out of another need. It really is remarkable, and I believe that Bitcoin treasury companies are kind of paving the way to an entirely new sector of global finance that Bitcoin wasn't touching. And they are accelerating Bitcoin adoption and Bitcoin's market capitalization as a result of that. In the same way that people, I believe, are going to kick and scream all the way from Bitcoin going to a $100 trillion market cap, I think people will kick and scream all the way to the monetary premium being sucked out of these traditional asset classes into Bitcoin, facilitated by Bitcoin treasury companies building these bridges. Joe, it's been fantastic to have you on. One last thing I want to chat with you about is a tweet that you talked about where you talked about how Bitcoin treasury companies traded a premium at MNAV. I mentioned we were going to talk about it earlier. I'd like to mention it now for the viewers at home. You said Bitcoin treasury companies tend to trade at a premium to their Bitcoin NAV, just like banks tend to trade at a premium to their book value. JPM trades at a 2.4x book value. MSTR trades at a 1.9x NAV. Banks keep issuing more loans, and treasury companies keep buying more Bitcoin. Right. So explain what you mean by this. And, we talked a little bit earlier about how, actually before we were on air, about how, Bitcoin treasury companies have the potential to become essentially the Bitcoin banks of the future. So it sounds here like you're trying to draw this analogy to justify at the very least a modest premium, or draw an analogy so people can understand why these treasury companies trade at a premium. So explain a little bit about what you mean with this tweet.
Yeah, with the tweet, I was trying to kind of create an analogy as to why these premiums could exist. And it's fun. To me, it's just fun to try to theorize why this is happening, because I view it more as like the market is, ascribed this value. It's kind of on our, brains to like figure out why the market, this all-knowing, pretty efficient machine, has decided to do this. Similar to Bitcoin, where it's like Bitcoin has, been the best performing asset of the last 16 years. It's like, as an economist or as someone that believes in free markets, at the very least, I think it should be interesting as to like, well, how is this even possible? Like, why is this happening? And not saying like, and not prescribing like, oh, well, the market's wrong because whatever reason. It's more just like trying to rationalize why this relatively all-knowing market, or we're highly intelligent market knows something that maybe you as an individual are not aware of. And so the idea of comparing Bitcoin treasury companies to banks based on their book value is interesting. And the way that I've kind of thought about it is like, okay, you have a bank like JP Morgan. Their business is having assets and liabilities. Like it's a balance sheet based business. Their assets are loans that they've made. It could be to the government holding T-bills. It could be to more long-term mortgages. It could be corporate bonds. It could be whatever. It's loans that they've made. That's their assets. Their liabilities are customer deposits. People that effectively have lent money to JP Morgan, and they have an IOU from JP Morgan that says you type in jpmorgan.com, you log into your account, you have $10 or $100 million or whatever it would be in your account. That's the bank's liabilities. And the bank obviously should have more assets than it has liabilities. And then from there, it's like, okay, well, on that spread of their assets to liabilities, their book value, banks tend to trade at a premium to their book value. In the exact same way that Bitcoin treasury companies, who also have assets and liabilities, where Bitcoin treasury companies, their assets are Bitcoin, their liabilities are debt, whether that's preferred equity or convertible notes or whatever it might be. And then that spread, happens to trade at a premium for Bitcoin treasury companies. And we call it like the MNAV premium. So this idea of like, okay, well, why does this exist to begin with? One way to frame it is JP Morgan as a bank, well, they're going to continue issuing more loans, right? Like just, if they have $4 trillion of assets and $3.5 trillion of liabilities, i.e. customer deposits, well, they could issue another loan and then create a customer deposit with that. And then also effectively, they grew their balance sheet a little bit more, and their asset that they created is paying a slightly higher interest rate than the liability that they created because they're paying a lower interest rate to their customer, their client. Bitcoin treasury companies are kind of the exact same way, where it's like they create a new liability where they borrow money at a convertible note, could be like 0 to 4% interest, or issue preferred equity might be like 8 to 12% interest. And then they invest the money that they raise from that and put it into Bitcoin, growing at maybe 30%. And so it's like banks can continue issuing more loans, lending money at 10%, and then, borrowing money from their client at 0% or 4%. They make money on that spread and they can grow their balance sheet over time. Bitcoin treasury companies are the exact same way, where they borrow more money and buy more Bitcoin over time. And so it makes sense as to why they would trade at a premium to their book value or their Bitcoin net asset value, because they can keep doing this over and over again as long as like their balance sheet continues to expand, the economy continues to grow, their debt ratio starts to shrink as the price of Bitcoin goes up. It's a unique way to frame how to think about Bitcoin treasury companies and how to potentially justify the premium.
Extremely well said. And I thank you for explaining it that way, because ultimately, it all boils down to this, right? The reason that banks trade at a premium to their book value is because the market has an assumption and a conviction that banks will use that premium to extend more loans in the future. They'll use that premium, that spread between what they have and what they're trading at, in order to continue doing their business in the future. The same exists for Bitcoin treasury companies. The reason the premium to NAV exists is because there's an assumption and conviction that not just this company, but the team that's executing this strategy will be able to, issue more debt, issue more equity, and also ultimately accrete Bitcoin for their shareholders over time, right? The market's pricing reflects an assumption that business will continue as usual. That's all it is, right? It's extremely novel, so it's understandable that people misunderstand this, but I think you framed it up there perfectly. And the last thing that I'll leave you with Bitcoin is the hurdle rate, essentially meaning that if an investment cannot supersede Bitcoin's CAGR, then it is not worth exploring, right? Ultimately, do you believe that buying Bitcoin is the most profitable thing that a public company can do today, in a world where essentially making things has a lower real yield than ever? It seems that the market is saying this. What's your take?
It's a good question. I mean, I think for the most part, yeah. On a risk-adjusted basis, Bitcoin growing at 30% per year, if that's correct, going into the future, it's hard to find something that's going to grow 30% per year that you're pretty confident in over a long period of time. There's been few companies that have outperformed Bitcoin over certain periods. Like NVIDIA is a pretty common example where you look back, 2014, something like along those lines, over the last 10 years, NVIDIA may have matched Bitcoin's performance, or may have even done better. But it's like one out of, thousands and thousands and thousands of companies. And so, yes, I think that it's very difficult to allocate capital outside of Bitcoin. And I think that that's why, these Bitcoin treasury companies exist. And I think that's why that, more will continue to exist, because it is, hard to deny it might be one of the best risk adjusted returns of the last 10 years and the next 10 years.
Bitcoin is the trade of the century, the trade of the millennia. We're moving through a great repricing now. And then ultimately, when Bitcoin is a $10 trillion, $100 trillion asset, it'll make it so that these Bitcoin treasury companies are the largest companies of the future. Semler Scientific, one of many, that is building that bridge. And I'm so excited to see what you continue to do over there, Joe. I have full faith and confidence in you and the rest of the team. Thank you so much for coming on. Before we leave here, do you have any parting words, or want to let people know where they can find you?
Yeah, no, Joe, thanks so much for having me on. It's always great to chat. Yeah, if you want to follow me, I mean, I'm at I Capital on Twitter. You can also search me on YouTube. I'm Joe Burnett. And if you want to learn more about Semler Scientific, you can actually go to our cool Bitcoin dashboard called it's ir.semlerscientific.com. Really cool place to check it out. If you've seen, strategies, MicroStrategy, MSTR, their dashboard, we have our own dashboard of our own, and it's pretty cool to see. So thanks so much for having me on. This is awesome.
Fantastic. Thanks as always, Joe. Pleasure to catch up. And you heard the man. If you want to see more of what he's doing, you can go to III Capital on X. And if you're watching this on YouTube, just search up Joe Burnett. Give him a subscription. He hosts a wonderful podcast over there called The Mustard Seed. He recently had Michael Saylor on that, as well as Tad, former CEO of Sotheby's. So go check out all of his content. You've probably already seen it. And of course, go to Semler Scientific's investor relations page, linked in the description, to check out their Bitcoin dashboard. Joe, thanks so much. And thank you guys for watching.